Well, I think it's safe to say at this point the stock market's either about one of two things. One, market psychology, or two, the robots have definitely taken over the trading. The jobs report for July is expected out tomorrow. This data is definitely going to matter. The Federal Reserve, the pen continues to be way mightier than the sword. And mortgage rates, that hard edge continues to come off, and affordability could be creeping back into the mix for the housing market. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. Hope you're having a great week. All right, well, the stock market's been through a wild ride this year. It's definitely forming some kind of a base here in the midst of the formerly known as a bear market for some of the indexes. Now, which direction it's going to go in, we'll see, but I can give you the report card on a year-to-date basis. The Dow Jones is up 10% from its 52-week low and down 11% from its 52-week high. The NASDAQ is up 20% from its 52-week low and down 20% from its 52-week high. The S&P 500 up 14% from its 52-week low, down 13% from its 52-week high. Do you see a theme here? All of these markets are middling in the middle of their respective ranges on a 52-week basis. Looks like either the psychology is stand still, we were a little bit oversold about a month ago, or we're embarking on the point where is this a bear market rally, which is going to lead to a severe sell-off. We'll see, but it looks like the robots could be in control based on where the indexes are right now. And the all-important 10-year Treasury yield, this is a very interesting one, sitting around 2.69 right now. That is down about 80 basis points from its recent 52-week high, and up 150 basis points from its recent 52-week low. This isn't exactly middling like the rest of the major indexes, but my guess is if they stay in the middle or go down a little bit more at this point, as markets continue to normalize, we're going to find the 10-year Treasury right in the middle of that range sooner rather than later. Now, as I said, the markets are going to try to pick a direction here. Definitely going to be data-driven. Federal Reserve that we're looking at. We are in a range right now, but what kind of base is this and what kind of range this is yet to be determined. But I can tell you this, the inflation report for the month of July is going to be out here in the next couple weeks. Tomorrow's jobs report and that inflation report for the month of July are definitely going to trigger the Federal Reserve headed into the fall. And a quick little note on the yield curves on Wall Street right now. Not only are the yield curves upside down, but they're also inside out. On a daily basis, if you didn't have the numbers next to them, you couldn't guess which one was the 2, which one was the 5, which one was the 7, which one was a 10, and which one was a 30-year Treasury note. Because once again, they're upside down, inside out, every which way but rational. And we all know this is a sign of an uncertainty and maybe big R word still yet to come. July jobs report comes out tomorrow. This is definitely going to matter because we're looking at a Federal Reserve that claims that they're completely data dependent. We know they're all interested in inflation, but jobs do matter. A couple quick notes headed into this jobs report. We received the jobs opening labor turnover survey number, the JOLTS number, which is basically a job openings number. That is down for the first time in a while. So there's less jobs available out there for those looking for them. Unemployment claims this week edged up again. Job openings down, unemployment claims up. We will see what's going on here in tomorrow's report. But the things I'm going to be looking at are A, wage inflation, because people need to be keeping up with the cost of living. 2, labor force participation. What percentage of the people that can participate in the labor force are actually participating? And 3, which I find to be low-key one of the most important factors of the jobs market, maybe the most important when it comes down to it over time, is the quality of jobs. Are these just jobs that you could be easily replaced, or you could easily replace your employer, or are these actual careers, which there's a long-term mutual benefit at hand here? So quality of jobs is a big thing. We'll see what things look like tomorrow for the jobs report. But I can tell you this. It definitely looks like for the first time in a long time we are embarking upon a slower jobs market based on some data points we're getting here. And I think that's definitely going to play into what the Federal Reserve does, as they know how important jobs and job quality are, especially that wage inflation, to keep up with the real cost of living. But big jobs report tomorrow for July. We'll see how it shakes out. Moving on to the Federal Reserve. Boy, that pen is still way mightier than the sword. So some funny things are happening with the Federal Reserve. Every time they raise interest rates, real interest rates on mortgages, for example, go down. But then when they put out a trial balloon and trot out one of the Fed governors to make a statement, rates go up. The sword is when they actually raise rates. The pen is when they talk about raising rates. Based on these reactions, the pen is still clearly way more powerful than the sword when it comes to the Federal Reserve. And as we're going to notice, central banks around the world, Bank of England in particular this week, they had their biggest rate hike in 27 years, keeping tune with Canada, keeping tune with us here in the United States. But as we see these central banks having these big leaps and bounds on raising rates, it just tells me that they are way behind the curve, and their real interest rate equivalents of our 10-year are also going down. So I think all central banks are behind the curve. We'll see how they shake out and how quick they start cutting rates, just like I believe our Federal Reserve will start doing sooner rather than later. And a quick little note about the markets. This pen, mightier than the sword thing is so true. Every time the Federal Reserve stays quiet for a week or two outside of their meetings, markets sustain themselves on a normal basis and trade based on what they should trade on. And treasury yields, people keep buying treasury yields because a 2.7% yield right now actually looks very attractive. So when the Fed's quiet, markets just do what they do. They go up, they go down, they trade. But every time the Federal Reserve trots out these trial balloons, markets and bond markets tend to sell off. We'll see where this goes. And the real estate market. Getting healthier, actually. I think we might have a setup for a pretty decent, better than expected second half of the year. Mortgage rates, the hard edge, as I mentioned, is definitely coming off. You saw that action in the 10-year Treasury. Couple quick little notes. Sellers' expectations are becoming more realistic with price adjustments, we're just going to call them today, to the buyers' affordability. And agents are actually starting to adjust to the new reality of this shifting every day ever so slightly towards a buyer's market. I don't think we're yet a buyer's market yet for a well-priced home, but we are definitely shifting towards one as rates stay a tad more elevated, but off their highs than they were in the last couple of years. And I'll tell you this, if we'd shed another 0.5% on mortgage interest rates, I think it could be party time again for the real estate market because we're getting to a healthy place where the consumer has adjusted their expectations and the sellers are beginning to adjust their expectations. And if that affordability comes back into play and the supply of homes, which is ever so slightly increasing now, continues, we should be headed into a second half of a virtually unnoticeable buyers and or sellers market, which is a very healthy market in general for real estate. Okay, everybody, that is my show for this week. I hope you enjoyed it. As always, if you have any mortgage-related questions, please don't hesitate to reach out to me. Have a great rest of the week and a very safe weekend.